What's going on, guys? It's your boy back at it again with another YouTube video. Today I'm about to cover swing points and liquidity runs. This is episode 1. Let me know how many episodes of this, I guess you can say, little mini boot camp I'm going to run. So let's just get into it. So why does price hunt stops? Most traders struggle because they don't actually understand what's moving the market, which I was there too back in 2019. They're taught support and resistance and breakouts, which we all know how that really works. It's not feasible. It's not good long term. But then again, if you use something long enough, guys, everything works. But what if I told you, this is my conspiracy brain going, my lizard brain, the market's really just moving from one liquidity pool to another? Huh? See, you like that? You like that? Yeah, it's pretty cool. It's pretty cool. So today I'm going to, just break down swing points and liquidity runs the simple way, a way that I wish I was taught when I was coming up trading. So this is some of the exact framework that I look for every day and how I take trades on a daily basis. So what do most traders believe? So most traders see the market higher high, higher low, higher high, higher low, higher high. They don't see what's under the hood here. They don't see this. I could point out to you right now, liquidity run ran away, had a turtle soup down here, came back up. These had a trend line right here, dropped down, took the liquidity on here, and we shot up. I can see that. But most newbie traders think higher highs, higher lows, a clean trend. Like most people think this will be a clean trend here. Because when you're just starting out, you have a trend line right there. So they believe the support holds, resistance breaks, and price continues in that direction. That's not how it works, guys. But you have to subscribe to this theory that I'm breaking down to you for it to make sense. If you want to use support and resistance, be my guest. I'm not here to change your mind. I'm here to help open your eyes to this trading style that helped me become a profitable trader. So when price breaks above a high, they think buy. That's not what happens. They're engineering liquidity with the short-term swing high. They run it and they run back down. That's if you don't believe it, guys, go to the daily chart. Go to actually any time frame on the chart and just look. Just look at it. So most traders, when it breaks above a high, they want to buy. When it breaks below, breaks below a low, they want to sell. And you ever notice you've done this before, and price runs rapidly in the other direction? That's what happens. This is exactly where most traders get caught, and that's where I used to get caught too, because the market doesn't move clean in reality. If we want to be real, guys, the market is just one big setup. So what swing points really are? Excuse me, swing points. A little dehydrated. It's okay. We got it. So let's shift the perspective here a little bit. Swing highs and lows are not just structure. As you can see right here on the chart, notice how we break above this high, and most traders, they will be buying right here. Notice we slam back down into the range of this swing high over here, and we continue lower to the swing low. Most traders will most traders will sell under the swing low right here. As soon as they start selling, smart money buys back up into it. You lost your money, you blew your account. That's just how it happens. But when it comes to swing highs and swing lows, guys, there are actually areas filled with orders. Above these highs, there's buy stops up here. Below these lows are sell stops down here. That means every swing point is a target. A target, guys. Understand that it's a target. So instead of seeing support and resistance, try to train your eyes to think of it as liquidity. Oh, we just took out a low? Someone's stop loss is right there. And when I say someone's stop loss is right there, yeah, you can think personal stop losses, but the market's not moving off our little money, guys. They're not going to care about your little 100, 200, 3,000, shoot, maybe 10, $20,000 if you got it like that. They're worried about hedge funds, people with the big money, people who are constantly putting millions and billions of dollars into the market because our money doesn't really help the market all that much. Yeah, in the back end it does, but they're worried about big banks. We need to start seeing liquidity. So where does liquidity sit? Now, let's talk about how where liquidity builds up. So we have your equal highs, you have your equal lows. Once you see equal highs and equal lows, guys, I gotta tell you, it sticks out like you can't miss this. If you see this on the chart on any time frame, your eyes shall automatically go, hey, I know what we're trying to do now. There is liquidity built up under these swing highs and swing lows. And as of today, the date is April 16th. This is the NASDAQ chart on the right. So again, where does liquidity sit? Previous highs, previous lows, any level that looks clean and obvious, guys. I cannot stress that enough. So pause this video, look at this chart. What looks clean and obvious on this screen to you right now? Is it this high, this high, this low, this low, this low, this high over here, this low? No, guys. Look at this. You can't miss this. And we have a little liquidity grab right here that took out this low and we ran away from it. But this is still a double bottom, relatively equal lows. Why? Because this is where traders place their stop losses. The market is constantly searching for these areas, guys. Just think about that. Just spend the night, look at your chart, and just look for relatively equal highs and lows. Look for areas that look too obvious to you. If it looks too obviously, it's probably liquidity. We've all been liquidity guys, trust me. My early days of trading, I used to get absolutely destroyed. So now we have our liquidity runs and or our stop runs. Now this is where things start to make a little bit more sense. So if we look at our graphic over here, we have a higher high, a low, a lower high, a lower high. Oh, excuse me, a higher low, a lower high. We take out this little short-term high, run this liquidity up here, run this liquidity up here. Then we sharply drop down under these relatively equal lows. Now, if you're a newbie trader, we broke through support. Now we should go back up, form resistance right here and continue down. That's what they're thinking. But if you buy under these relatively equal lows, you will move price up. Not saying you will move price up because you have $1 billion, but they will move price up and you'll just catch a ride. It's like riding the train, guys. It's like playing a video game. Like once you know the boss's moves, they can only do so much to you. So when price runs above this high, takes out all those buy stops, and then instead of continuing, it reverses. It happens all the time. This is called a liquidity run or stop run, depending on who you're talking to. It's all the same thing. Really all the same thing. This is where most traders enter. So take a look at that chart. Really soak it in, guys. Really soak it in, because I'm telling you, it's ridiculous. But in reality, they're just providing liquidity for the market. That's all it is. Now, I'm pretty sure everybody who's ever seen somebody use support and resistance, there's traders on YouTube who use support and resistance. Take this. Look at this chart. I'm pretty sure you've seen it over and over again. This is the trap. This is the trap they use every single day on every time frame, and it does the same thing over and over again. Price breaks above resistance. Everyone sees a breakout. Oh my gosh, let me put my stop here. Next thing you know, they're buying, they're buying, they're buying. Everyone sees a breakout. Again, most traders are buying. But what's actually happening, guys? The market's taking their liquidity. See the reversal? It happens. It happens all the time. So imagine you see this on a daily chart, and this is your next daily candle. You've already positioned yourself for like billions of dollars, guys. This isn't financial advice, but I'm trying to share my wisdom. This is how it happens over and over and over again. And right after that, after they run your stops, price moves in the opposite direction. The breakout was never the move, it was the setup. This is how the market transfers money from retail traders to smarter people. I'm not calling you dumb. You're just uninformed. You're uninformed money. That's why it's called smart money. Smart money concepts, smart money techniques. Smart money is the people moving the markets. Simple as that. So right here, we have clean highs. To the right, we have a sweep reversal. This is the NASDAQ chart. Notice, see how these relatively equal highs just stand out? We're just gathering liquid. This is the daily chart, guys. This is the daily chart. So notice we run above, and you can position yourself on the next day. Always wait till the next day, because if you try to sell, even advanced traders, this is really hard to do. If you can position yourself on the next candle, let the next day open up. Wait for like some kind of SMT. We take out, let's say SPX. They take out the previous day high right here, and that will be your confirmation to go short. Here on NQ, we did not take out that previous day high. I'm pretty sure we had a SMT play right there, but nonetheless, look how we ran these equal highs, and we just trended down another direction, and we ran these lows right here. So that's really just how liquidity gets taken, and now we can see the real move begin down here. So how to think differently? I know what I gave you, it's very basic. I try to keep it very basic because a lot of people aren't really ready to accept it. So you're probably asking, how do we actually use this? Well, stop chasing breakouts. I guarantee you will keep a lot of money in your trading account if you just stop chasing breakouts. Also, identify, write this down, write this down, write this down. Identify where liquidity is sitting, guys. I already told you swing highs, swing lows. Swing highs, swing lows. And then we look for the move in the opposite direction. Is it relatively equal highs right here? Relatively equal lows right there. We're not predicting, we're just reacting. Because a lot of people lose in this game because they're trying to predict. You need to be reactive. I'm not sure if you guys heard of an if then statement. If it does this, we want to do that. That's how we have to move in the markets, guys. If and then. That's it. So just to recap, so let's simplify everything. You know, this is probably the longest video you probably watched today, so I'm not trying to hold you too long. So let's simplify everything. So swing highs and lows equals liquidity. The market moves to take that liquidity. Breakouts can be traps. The real move comes after the liquidity is taken. That's it. That's it. So notice on the right side of the chart here, NASDAQ, we have relatively equal lows down here. We run it. But what else do you notice? Relatively equal highs. And NASDAQ is always short-term bullish, guys. Short-term bullish. But I guarantee you, after this video is uploaded, we have already ran those highs. Because that's how the market works. But I know this presentation was very short. I kept it very basic. I have more videos coming in the future. I just did it off the top of the head, guys. I just want to help you guys. I want you guys to be profitable traders, man. There's too many gurus on this space who are teaching you everything besides what you need to know. And that starts with me. If this helps you understand the market better, stay tuned for more content like this, guys. I'm also going to have car content as well. I'm going to be breaking this down step by step especially for beginners, my intermediate traders. So follow me on YouTube, follow my Instagram, and stay safe in the market, guys.